Friends, thank you for being here today. What if I told you that by simply not using buy now, pay later, you are still paying for it? And what if I told you that the very companies offering you this free service are simultaneously losing billions of dollars providing it? We have entered a new era of consumer finance, a period that can aptly be described as a debt renaissance. At the center of this movement is a deceptively simple financial tool, buy now, pay later, or BNPL, spearheaded by a new generation of fintech giants like CLA, Affirm, and Afterpay. This model offers consumers a form of short-term unsecured personal loan, allowing them to split the cost of a purchase into a series of smaller, more frequent installments. Typically, this manifests as the pay-in for model where a total cost is divided into 4 equal payments spread over several weeks. This mechanism is in essence a modernized and digitized version of the 20th century layaway programs once common in department stores. However, it comes with one critical game-changing difference that defines its appeal: instant gratification. Unlike layaway, where the store held the product until the debt was paid in full, BNPL providers deliver the product immediately. The consumer gets the rush of the purchase, the new shoes, the electronics, the concert tickets long before the financial reality of the payment is complete. This combination of immediate reward and deferred financial consequence has proven to be a potent and wildly successful formula, and the scale of this new industry is staggering, which really speaks to a fundamental shift in consumer behavior. By some estimates, the buy now, pay later industry now holds an astonishing $500 billion in outstanding debt. The velocity of its growth in the United States alone illustrates a near vertical adoption curve. In 2019, the total U.S. transaction volume for BNPL services was approximately $2 billion. By 2025, that figure is projected to explode to $122 billion. This isn't a niche product. It is a mainstream financial force. Today, it is estimated that 4 out of every 5 Americans have used a BNPL service at least once. The big 3 providers, CLA, Affirm, and Afterpay, boasted a combined active global user base of over 173 million people as of 2021. This rapid normalization has forced the hand of the financial establishment. The model has been so disruptive that it is no longer being ignored by the old guard. On the contrary, it is being embraced. Major legacy and tech players, including Apple, which has now partnered with both Affirm and CLA, Visa, MasterCard, and PayPal, have all launched or integrated their own versions of BNPL, cementing its status as a permanent fixture in the financial landscape. This explosive growth was not a coincidence, though. It was the result of a perfect storm of 3 converging trends. First was the maturation of e-commerce and the rising desperation of merchants. In the hyper-competitive online marketplace, retailers face astronomical customer acquisition costs. They are locked in a perpetual battle for conversions, seeking any possible edge to turn a window shopper into a buyer. BNPL emerged as the perfect weapon. It offered a seemingly frictionless way to push consumers over the final hurdle at checkout, reducing cart abandonment and driving higher sales volume. Second, a profound generational mistrust of traditional finance, particularly among millennials and Zoomers, created a vacuum that BNPL was custom-built to fill. This cohort came of age in the shadow of the 2008 financial crisis and views traditional credit cards as predatory. They are wary of the fine print, the hidden fees, and the punishing 19 to 23% annual percentage rates APRs associated with revolving credit card debt. BNPL successfully marketed itself as the friendly, transparent, and fair alternative, the antidote to the perceived sins of the big banks. And third, this was all amplified by a set of powerful cultural shifts. We are witnessing the financialization of everything. A new mindset where no purchase is too small to be financed. The concept of using an installment plan once reserved for a refrigerator or a car is now being applied to a 15 burrito on DoorDash. This is coupled with the rise of social media driven consumption. Influencer culture on platforms like Instagram and TikTok creates a constant stream of aspirational desire, showcasing luxury lifestyles that BNPL makes feel attainable. Finally, the post pandemic revenge spending boom saw a population wary from lockdowns, eager to spend on discretionary items and experiences. BNPL provided the easy money to fund this collective splurge, allowing consumers to treat themselves without the immediate financial sting. So, this brings us to the next logical question. Why is this so appealing to consumers? What are the psychological hooks? Well, the primary allure of buy now, pay later, the hook that catches millions of users, is the promise of interest free money. The standard pay and for model where four equal payments are made every 2 weeks typically carries a 0% interest rate. For a consumer conditioned to fear the 23% compounding APR of a credit card, this offer feels like a financial life hack. It presents itself as all the upside of credit, getting the item now with none of the downside, the crippling interest. This free money illusion is the single most powerful marketing tool in the BNPL arsenal, creating a perceived barrier between smart BNPL users and irresponsible credit card users. But this interest free promise just works in tandem with a sophisticated and highly effective psychological apparatus built directly into the e commerce checkout process. BNPL companies are masters of behavioral economics, employing a series of tricks to nudge consumers toward their product. First, they exploit a concept known as the pain of paying. The human brain processes a 100 purchase very differently than it processes a 25 purchase. By splitting the cost, BNPL dramatically reduces the immediate perceived financial pain, making the transaction feel smaller, more manageable, and less significant. A 100 item feels like a 25 item. Second, the model triggers temporal discounting, a cognitive bias where humans overvalue immediate rewards and heavily discount future costs. The instant gratification of receiving the product today is a powerful, tangible reward. The abstract cost of a 25 payment 4 or 6 weeks from now feels distant and hypothetical. As one user aptly put it, I don't know me 2 months from now, she can deal with that. BNPL allows the present self to indulge, pushing the financial responsibility onto a future abstract version of oneself. Third, these cognitive biases are amplified by manipulative user interface UI and user experience UX design. This is not a passive choice. At checkout, the BNPL option is often highlighted in bright, welcoming colors. It may be larger than the pay in full button or even pre-selected by default. These are deliberate design decisions intended to short-circuit rational financial thought, encouraging an impulsive click based on the low pain of paying rather than a careful consideration of the total long-term cost. Finally, the system is built for easy access. Unlike a traditional credit card, which requires a formal application, a review period, and a hard credit pull that can lower one's credit score, BNPL offers instant approval. With little more than a name and a phone number, a consumer can be granted purchasing power, making it a tempting backdoor to credit for young borrowers or those with low credit scores. Of course, as you've probably guessed, beneath this frictionless, interest free surface lies a much more dangerous reality. The catch for this convenience is often buried in the terms of service, and a significant portion of users fall into its traps. The interest free illusion shatters the moment a payment is missed. Users are then hit with hidden late fees, which can range from $2 to $15 per missed payment. While this may sound small, these fees can accumulate, and some services cap their total fees at a staggering 25% of the original purchase value, an effective interest rate that rivals the very credit cards BNPL claims to replace. The data shows that these are not edge cases. Delinquency is rampant. An estimated 1 in 3 buy now pay later users has missed at least one payment. In the past year alone, 41% of users paid late. This suggests the 4 easy payments model is not as easy as it is marketed, and that many users are more financially precarious than they believe. This leads to the behavior of loan stacking, because each transaction is so small and so easy to initiate. Users are encouraged to take out multiple loans simultaneously. According to one study, 63% of BNPL borrowers had more than one loan active at a time. The Don 15 burrito, the 50 gas fill-up, and the 100 pair of jeans are all financed on separate overlapping schedules, creating a confusing web of micro debts that are nearly impossible to track. Most alarmingly, this behavior has bled from discretionary purchases into essential goods. A growing number of consumers, estimated at up to 25%, are now using BNPL to finance groceries, gas, and utility bills. This is no longer revenge spending. This is a clear signal of profound financial distress. These users are not financing a luxury. They are financing their survival using high-cost short-term debt to bridge the gap between paychecks. This data paints a clear and troubling picture of the average BNPL user. They are often the most financially vulnerable. Studies show that 69% of BNPL users already carry existing credit card debt. 28% are young, between the ages of 18 and 24. A report from the Consumer Financial Protection Bureau, CFPB, confirmed this, finding that over two-thirds of BNPL loans are extended to borrowers with lower credit scores. The very people who are least equipped to handle complex debt are the ones being targeted most aggressively. This leads to a really crucial point. You have to understand who this business model is really built for. While marketed as a consumer-friendly finance tool, the truth of the BNPL business model is that it was not designed for consumers at all. It was designed for merchants. At its core, buy now, pay later is a sales and marketing tool. Retailers do not adopt this technology out of generosity. They adopt it because it measurably and dramatically increases sales. The data is undeniable. Consumers who are offered a BNPL option at checkout are 17 to 26% more likely to complete a purchase. Not only do they convert more often, but they also spend more. The average purchase size or average order value is reportedly 10% larger when a BNPL option is used. The cumulative effect of these two metrics is a staggering 30% increase in discretionary spending. For an e-commerce merchant operating on thin margins, a tool that promises to boost revenue by nearly a third is not just an option, it's a necessity. This sales boost, however, comes at a significant price. The cost is simply hidden from the consumer and pushed onto the merchant, who in turn pushes it on to everyone else. First, retailer pay exorbitant merchant fees while a retailer might pay a credit card processor like Visa 1.5 to 3.5% of a transaction's value. They pay BNPL providers a fee in the range of 5 to 8 cents. This is a massive cut of their revenue, often larger than their entire profit margin on the item being sold. Second, a no surcharge clause in the merchant agreement contractually forbids the retailer from passing this 5 to 8% fee directly to the customer who is using the BNPL service. The merchant cannot legally charge the BNPL user more than the cash paying user. This leaves the merchant with a problem. To cover this massive new expense without going bankrupt, they have only one choice. They must raise the base price of their goods for all customers. This creates a hidden tax. The responsible consumer who pays in full with cash or a debit card is now paying an inflated price for their goods. They are in effect unknowingly subsidizing the interest-free loan of the BNPL user standing next to them. This has created an arms race for retailer exclusivity. The BNPL giants are in a fierce battle to become the sole financing partner for the world's biggest retailers. This has led to massive exclusive deals such as Clara's partnership with Walmart and Affirm's deep integration with Amazon. These exclusive MOs lock in a steady stream of transactions and force consumers to use a specific provider, further solidifying the market power of the big three. Now, herein lies the central paradox and the most bizarre part of the BNPL industry. Despite its explosive growth, its massive user base, and its deep integration into the global economy, the business model is fundamentally and spectacularly unprofitable. These companies are, as one analyst noted, remarkably bad at being predatory. The corporate balance sheets are a sea of red ink. A firm in one recent year lost nearly 500 million, which was celebrated as an improvement from its nearly $1 billion loss the year before. CLA, once the darling of European fintech, saw its highly anticipated IPO stall after its private market valuation crashed by a staggering 80%, plummeting from 45 billion to just 7 billion. This is in stark contrast to the traditional credit card industry they aim to disrupt. For banks, credit cards are a golden goose, reportedly 4 times more profitable than other products like mortgages or personal loans. The BNPL industry, meanwhile, appears to be a house of cards built on a model of growth at all costs that is hemorrhaging cash. The reason for these losses is found in the real financial mechanics of a BNPL transaction, which are far more complex than they appear. First, BNPL providers are for the most part brokers, not direct lenders. When a consumer makes a purchase, the loan is not typically funded by CLA or Affirm. Instead, they partner with a handful of obscure state-chartered banks such as Cross River Bank or Web Bank, who actually originate the loan. This leads to the single most costly part of their business, a line item known as the loss on loan purchase commitment. The process works like this. A consumer buys a DON 100 item using Affirm. The partner bank, for example, Cross River Bank, instantly funds the loan, paying the merchant minus their fee. Per their contract, Affirm is then obligated to buy back that 100 loan from Cross River Bank at its full face value. In addition to buying back the loan, Affirm must also pay Cross River Bank a separate origination fee for their service. On a 0% pay in 4 loan, this is a mathematically guaranteed financial loss for Affirm from the very first second. They pay more than 100 the loan value plus the fee for an asset that will only ever return them a 100 assuming the customer doesn't default. So if the most popular product is a guaranteed money loser, why offer it? The answer is that the 0% pay and for loan is a loss leader. It is the bait used to acquire customers and, more importantly, to balance their loan portfolio. BNPL companies need to attract prime borrowers, those with good credit, to make their loan books look stable to investors. These prime borrowers are the ones who are most attracted to the 0% offer. The real business model and the only hope for profitability is to upsell this blended pool of prime and subprime borrowers into longer-term interest-bearing loans. For a firm, this high-interest segment reportedly accounts for 80% of its business. The pay and for model is simply the marketing funnel to get users in the door, with the ultimate goal of graduating them to loans that carry APRs rivaling the very credit cards they critique. To plug the massive financial hole left by their core product, these companies have bolted on a variety of other revenue streams, all with varying degrees of success. First, merchant fees. This is the primary revenue stream, but as discussed, it's high cost and competitive. Second, interest income. This is the intended profit center, but it is often wiped out by high default rates. As Clara's financials showed, their 136 million in unraveled loans in one quarter far exceeded their profits from interest. Third, late fees for companies like Afterpay and CLA. These fees are a substantial and necessary source of revenue. Fourth, data harvesting. They collect and sell user shopping habits and data to other brands as a marketing service. Fifth, securitization. As we'll see in a moment, they package their loans and sell them to investors. And sixth, becoming a bank in a final ironic pivot. Companies like Affirm and CLA are now aggressively pushing high-yield savings accounts. The goal is to use these customer deposits as a cheap source of capital to fund their own loans, thereby cutting out the expensive middlemen banks like Cross River. But the debt renaissance has not stopped at BNPL. A new and arguably more dangerous category of financial app has emerged: earned wage access (EWA), embodied by companies like Earnin, Dave, and Daily Pay. These apps are for all intents and purposes a high-tech reinvention of the predatory payday loan. The premise is simple. An employee has already worked for, but not yet been paid their wages. These apps allow them to access a portion of those earned wages immediately before their official payday. While the premise sounds helpful, the business model is built on the same deceptive practices as its payday loan predecessors. First, these apps avoid the term interest. Instead, they monetize through a confusing array of service fees, monthly subscriptions, and most deceptively, tip. Users are aggressively prompted to leave a tip for the free service of accessing their own money. Second, this tipping is not passive. It is highly coercive. App interfaces have been shown to use up to 17 separate prompts to guilt a user into tipping. These prompts often default to a high amount, such as a pre-filled or 11 tip, and use psychological tricks to make the user feel cheap for declining. Third, this model is a deliberate legal loophole. The companies and their lobbyists argue that this is not a loan because the user is accessing their own money. This legal fiction is designed to evade state and federal lending regulations such as interest rate caps. Fourth, the true cost is astronomical. A study by the California Department of Financial Protection and Innovation calculated the tips and fees of these apps, and found they were equivalent to an average annual percentage rate APR of 300 and pro 34%. This is a predatory rate by any definition. Finally, this creates a devastating debt cycle. A user borrows from their next paycheck, which means their next paycheck is smaller. This the new high tech payday loan, the rise of earned wage access, the 2008 parallel, how unsecured debt becomes a systemic risk. Smaller paycheck makes them more likely to be short on cash again, forcing them to borrow again from the app, often in larger amounts. Users become trapped, borrowing from multiple apps just to stay afloat, digging themselves into a hole of riskier debt from which it is nearly impossible to escape. So, what does all of this mean? What are the systemic risks, and where is this all headed? Well, the combination of these factors, easy credit, unregulated lending, and a focus on high-risk subprime borrowers, draws alarming and eerie parallels to the 2008 subprime mortgage crisis. While the scale is different, a 400 shoe is not a 400 Zalosen house. The underlying mechanics are worryingly familiar. The most direct parallel is the practice of securitization. BNPL companies like Affirm are actively bundling these high risk subprime consumer loans, thousands of small unsecured debts for discretionary goods, and packaging them into complex financial products known as securities. These securities are then sold to Wall Street investors, effectively passing the risk on. Let's break that down because it's not just a passing comparison. It's the exact same financial plumbing that brought the global economy to its knees. The core driver of the 2008 crisis was a model called originate to distribute. This is a system where the entity that creates a loan, the originator, doesn't keep the loan on its books. They sell it off immediately, thus distributing the risk to someone else. Or at least that's the theory. This is precisely what the BNPL companies are doing. In 2008, these products were called mortgage-backed securities, MBS. Today, the BNPL versions are called asset-backed securities, ABS, but the principle is identical. You take thousands of small risky debts, package them together into a bundle, and then sell slices of that bundle to Wall Street investors, pension funds, hedge funds, investment banks who are all desperate for a slightly higher rate of return in a low-interest world. Here's the problem, and it's a terrifyingly significant one. A mortgage, even a subprime one, is backed by a physical asset. It has collateral. It's a secured loan. If the borrower defaults, the bank can foreclose on the house and recover some or maybe all of the value. So we have to ask the critical question, what collateral backs a buy now, pay later asset-backed security? A 400 pair of sneakers that are now scuffed, a 2015 burrito that was eaten 6 weeks ago. The answer is nothing. This is unsecured debt. It is a loan based on nothing but a pinky promise. If the borrower decides to stop paying, that money is gone. Poof. This makes these new securities exponentially riskier than the mortgage-backed securities that caused the last meltdown. This originate to distribute model creates what economists call a moral hazard. When a company like Affirm or CLA knows it can sell off a loan just days after it's created, what is their incentive to ensure the borrower is actually qualified to pay it back? The incentive disappears. In fact, the incentive flips. Their only motivation is to originate more loans faster, regardless of quality, in order to generate more fees and feed this securitization machine. Underwriting standards are not just relaxed, they are seen as an obstacle to growth. This is the exact same race to the bottom that led to the infamous ninja loans of the mid-2000s, loans given to people with no income, no job or assets. So when these BNPL companies boast about their proprietary AI underwriting that can instantly approve anyone, what they are often really boasting about is their efficiency at issuing high risk loans to the very two-thirds of their users who, as the CFPB found, have low credit scores. And Wall Street once again is buying this bundled up debt, stamping it with a good credit rating, and reselling it all while pretending it's a safe investment. The systemic risk isn't just that a few consumers will default, it's that a significant portion of the financial apparatus is once again being built on a foundation of the most unstable, uncollateralized consumer debt imaginable, sold to investors who are told it's safe. The danger is clear. In a recession or an economic downturn, these BNPL loans will be the first to be defaulted on. Consumers will understandably prioritize their mortgage, their car loan, and their utility bills over their paying for plan for a pair of sneakers. When that happens, and it will, these bundled securities, which are currently being sold as stable assets, will suddenly and rapidly become highly toxic and potentially worthless, sending shock waves through the financial institutions that hold them. Like many Silicon Valley disruptors before them, such as Uber and Netflix, the BNPL industry is currently in its first phase, take market share. This phase is funded by billions of dollars in venture capital, allowing them to subsidize the user experience with money-losing offers like 0% loans to acquire a massive user base. The second phase, the achieve profitability phase, is inevitable. To survive and to satisfy their investors, these companies must eventually make their service worse for the consumer. This bait and switch endgame will mean higher merchant fees, which will be passed on as higher prices for everyone and more hidden, complex and unavoidable fees for customers. The free, easy, and transparent tool of today will by necessity become the predatory, expensive, and opaque system of tomorrow. The future of this industry will be defined by the regulatory and market response. In the United States, the Consumer Financial Protection Bureau, CFPB, has made attempts to regulate the BNPL industry like traditional credit card providers. But these efforts have been slow and have faced resistance in a largely anti-regulation political climate. A more immediate change may come from the credit reporting bureaus. FICO, the company behind the dominant credit score, is now beginning to incorporate BNPL data into its scoring models. This is a double-edged sword. While it may provide more transparency, it could also severely penalize users, especially young ones, who were led to believe they were using a smart tool only to find it has damaged their creditworthiness for years to come. Amid this chaos, a potential solution may be emerging. A new trend of pay by bank services powered by companies like Plaid is gaining traction. This model uses direct bank TONC EFT transfers, cutting out the card networks and the entire web of middlemen. This is what BNPL claimed to be. This new model, which could be up to 40% cheaper for merchants, may represent a genuine path to a more efficient and honest financial system, one built on actual technological innovation rather than psychological manipulation and a hidden fee shellgate.